Well, welcome to our next panel, and hopefully these issues aren't as unmovable as that podium was. The title of this panel is Reassessing Tide Misfortunes, Valuing Government Assets and Liabilities. We've got some really distinguished panelists. I want to get into it. Tide fortunes, hopefully it's not tide misfortunes. And what we're going to talk about is the fact that the way government, the US federal government views assets and liabilities sometimes doesn't always align with economic reality. And the way that you measure this really does matter. And we're going to show that. And hopefully the reason why we all care so much about this is because by having better valuations for assets and liabilities, policymakers are not only compelled to take action, but also compelled to make better policy decisions. So hopefully we can kind of walk you through that and show you new ways of thinking when it comes to assets and liabilities. So let's get into it. I'm going to try to work this slide clicker here. And if someone...
Here, it worked.
Did it work? OK, here we go. So by the way, I don't want the US to lose its exorbitant privilege, because if it does, this gets a lot worse. I'm going to go over just a few slides about our fiscal picture. I think a lot of you know this already. But basically, debt is on an unsustainable path as it is. And what I'm going to talk about is kind of the knowns, right? These are the explicitly known projections of the US fiscal picture and kind of the fiscal imbalance. And we know the growing debt is caused by this structural imbalance between spending and revenues. And it's continuing, that gap is continuing to widen. If you look at federal spending and revenue as a percentage of GDP, it's mainly driven by our entitlements. Social Security and Medicare are the two biggest drivers. Social Security is the largest program in the federal government. We may have some discussion on that. Total unfunded obligations, though, of these two programs alone, if you look at it over a 75-year horizon, it's over $78 trillion. So it's really hard to I think it's hard to wrap your head around any levels of kind of federal debt, but this is an especially hard number. And the other thing to point out is that net interest is also growing as our debt grows. Financing our debt and becomes a major issue, and is squeezing out the ability to kind of undertake other government expenditures and programs. So if you think about right now, and in fact we just crossed this kind of Rubicon, we are spending more on interest than we are on national defense in the US. And Social Security itself, Social Security Trust Fund will be depleted. There will be shortfalls, and it is not, it used to be one of those things that was hypothetical that we talked about. This is coming in decades. The last major Social Security reform is 1983, right? This is right around the corner. This is 2034. Medicare also is facing major shortfalls, especially as kind of we have an aging demographic, and obviously the cost of healthcare is increasing. So look, these are the I would say known projections, the known variables, the things that we talk about a lot, and I talk about them a lot at the Peterson Foundation. Debbie's going to talk a little bit about new ways of viewing government investments and also some of the unknowns on the budget and some of the things that maybe aren't as explicit. So let me turn it over to you.
Okay.
Here we go.
Great. Thank you. My slides are coming, so I'll just start to talk, which is to say that what Dana's graphs and everything else we know makes it abundantly clear that we're on an unsustainable fiscal path. And one of the responses to that has there's been a lot of renewed interest in the US and also elsewhere in the world, and using government investment policies to reduce fiscal imbalances. So I want to start with the question, is there any reason to think that these policies could work? And I will answer it in one sentence, which is one word, an unequivocal no. Certainly government investments in assets with important positive externalities, critical infrastructure, or basic research support higher productivity and growth, and that might ease future fiscal strains. However, neither economic theory nor historical experience suggests that a government with highly negative net worth, which is what we've been talking about, will come out ahead by borrowing more money and investing it in risky corporate stocks. And I want to make the contrast that I wouldn't say out of Norway, which has positive net worth. They have oil wealth they want to diversify, but we're talking about starting in a negative net worth position. Okay, so the reason is straightforward. A nation with negative net worth is going to have to borrow whatever money they invest in those risky assets. Or they could raise taxes, but that seems highly unlikely. So simultaneously issuing more debt and buying stocks is, at best, a neutral fiscal transaction. At worst, it erodes value if the assets are mismanaged. And I just wanted to kind of illustrate the situation on these slides. So this is actually taking the Treasury's balance sheet. And in a way, I don't like to show it because these are book values. And they're kind of misleading book values because it's a very narrow definition of assets and a very, it's actually also a narrow definition of liabilities, but it still illustrates the point. So if you look at the government's current fiscal position, even if you measured it properly, the assets would be far lower than the liabilities, and that puts the US in a negative net worth or negative equity position by the Treasury's estimate, book value estimate of about $40 trillion. So let's ask the question, what if the government goes out and they raise debt and they use that debt to buy stocks? Specifically, imagine that they decide to create a sovereign wealth fund and to raise $1 trillion of debt and put that $1 trillion of debt into the sovereign wealth fund. What happens to this balance sheet? Well, the assets go up by $1 trillion because they pay a market value for the assets. The debt goes up by $1 trillion, but nothing happens to that negative net worth position. Okay. Something else that does happen is that we've added risk to this balance sheet. We've added leverage because we've added this relatively safe debt against a risky asset. So it does increase the problem of problems in the future. Okay. So this conclusion that I just came to, that these types of investments would add fiscal risk without adding value, is probably very uncontroversial here in this room. But nevertheless, several recent proposals by the Trump administration and by members of Congress claim that these policies could create significant value added. So just to give you an example, the administration has said that they wanted to establish a sovereign wealth fund, and they have a plan for doing that. Recently, they backed away a little bit from literally a sovereign wealth fund, more towards making strategic investments in critical industries, and they started to do that by buying $8.9 billion of Intel stock very recently. So now the US government owns about 10% of Intel. On the Social Security side, there's Senator Bill Cassidy and Tim Kaine, a Republican and a Democrat, have proposed what essentially is another kind of sovereign wealth fund, but a kind of investments, risky investments, in order to offset the Social Security shortfall that Dana was talking about. So you have these proposals. So I think a harder and more important question to answer is, why do even very well-meaning policymakers believe that these schemes could increase fiscal resources? And I'm going to make the case that a crucial part of the problem is government accounting rules that drive a wedge between policymakers' perceptions of value and economic reality. Specifically, they neglect to take into account the cost of market risk to the government. But fortunately, there are ways that could be fixed if there were the political will to do so. And so that's really the hard part. But anyway, I want to use the rest of my time to briefly provide some concrete examples of the significant distortions in the information that policies are getting now through bad government accounting, and how changes to those government accounting rules and policies could fix that. So first, let me turn back to risky government asset purchases like a sovereign wealth fund or a separate fund in Social Security. Why does that seem feasible to policymakers? Well, the idea that this policy could fix that comes from what I would call budgetary alchemy. Governments typically use their own borrowing rate to discount just about everything, including those investment returns. And even though markets are discounting those investments at much higher rates, when you do the math using those two different rates, you basically have a money machine for the government where you can fix any perceived hole by taking a highly leveraged position in risky assets. So how can that distortion be fixed? Well, that's one thing that I've been, I think, saying until I'm blue in the face for decades. We could fix that by applying the same fair value accounting principles that are used by the private sector when we account for government investment activities, particularly in the context of budgetary accounting for investments. But let me turn to something else, which is state-owned enterprises. There's been a lot of renewed interest also in industrial policy. And with the growth of China, state-owned enterprises now comprise a large and very significant growing share of global economic activity. So these graphs were borrowed from the IMF from a very nice chapter they wrote a few years ago. But kind of the focal numbers here is that there's about 45 trillion in non-financial SOEs in the world economy, and that was as of 2018. And it's about 20% of the assets of the world's largest 2,000 non-financial firms. So really a large footprint. So you have this growing share of SOEs, and then the figure on the right is showing that sector by sector, as measured by return on equity, these SOEs are performing more poorly than their private sector counterparts. So I spent the last year on sabbatical at the IMF thinking about the right way to measure the value of government financial subsidies to SOEs and the shortcomings of the metrics that are currently used to measure their financial health. And in a recent academic paper that grew out of that work, my co-authors and I conclude that it's the reliance on accounting profits as proxies for economic profits which cause policymakers and the managers of state-owned enterprises to believe those enterprises are creating much more value than they really are. And so here again, the root cause of the valuation distortion is a lack of recognition of the cost of market risk. Interestingly, in this case, it isn't a problem with government accounting rules because, in fact, most SOEs use the same financial reporting standards as the rest of the industries in whatever country they're in, either GAAP or IFRS. So instead, the problem is that accounting profitability is just a poor proxy for economic profitability, whether for an SOE or for a private firm. You know, accounting profits are going to be positive even if equity holders, government equity holders, receive returns that are far below what they could have earned on a similarly risky private sector investment. All of that, all they have to do to have positive accounting profits is to cover their fixed expenses, including the interest that they owe. Now, of course, private sector firms also look at their accounting profitability, but they get other more reliable signals about their economic value through their stock price, which is going to reflect, you know, the true required return on the stock. So these unrecognized losses from SOEs create what I like to call a slow bleed of the fiscal resources of governments and actually of society. So I think in this case, there's also a solution, and it lies in replacing accounting profitability with economic value added, which is kind of a private sector idea, as kind of the focal metric for assessing the adequacy of SOE returns. And there's a link to a paper on it, way too hard to explain right now. But I'll just say that when you apply this different metric, economic value added value, rather than these kind of traditional metrics like ROE, to the Tennessee Valley Authority, which is one of the largest SOEs in the United States, it really changes one's picture of whether they're making money for the government or losing money. So if you look at their accounting statements, they're modestly profitable in every year over the last 2 decades, whereas our calculations show that they were losing about $500 million per year in each of those years. Okay, so last major topic, investing involves selling assets as well as buying assets. And the government in the United States is currently involved in some potentially very major asset sales, particularly the proposal to reprivatize Fannie Mae and Freddie Mac, but also there was discussion that I think now is on hold of selling millions of acres of Western public lands, and also this came out yesterday, the administration proposed selling parts of its federal student loan portfolio. So clearly, we want policymakers to have accurate information about whether an asset sale is going to create value or destroy value for the government. So in general, an asset sale involves trading an asset of some value for cash of equal value. If the government sells an asset for less than its market value, it's losing money, and vice versa, if it could sell it for more than its market value, which it probably can't. Okay, so what's the problem here? Well, the budgetary accounting rules in the United States for asset sales cause the budgetary effect of a sale to be significantly different than its economic effect, very often showing a gain when there would be a loss, but also sometimes vice versa. So here, the two main culprits are cash accounting and the failure to look at the market value of the assets, or to mark the assets to market. So another way to describe the problem is that budgetary accounting doesn't have any kind of depletion accounting built in. So just to give you a very simple example, imagine that the government owns $1 million worth of trees in a forest, and they decide to cut down that forest, and they sell the wood for $200,000. On an economic basis, they've lost $800,000 because they sold the trees for $800,000 worth than the lumber was worth. But in the budget, they would show a gain of $200,000 because there is no cash transaction. There's no cash involved with keeping the forest, but there is cash involved if you sell the trees. So particularly in these ecological examples, it's a big problem, but it would also be potentially a big problem if that's how you accounted for Fannie Mae and Freddie Mac when you sold them. So, that seems very daunting, but a rule change that could go a good way towards fixing that problem in the budgetary accounting framework would simply be to add a requirement that assets be marked to market before the accounting for the effect of a sale was taken into account, because then you would be capturing, the value that you gained or you lost. And what's actually good about that proposal is it's not asking you to mark everything the government owns to market, but rather just anything that they're planning to sell. So this seems like some issues I hope we can talk about more.
And it seems like a great segue to Paul Willen from the Boston Fed. I just want to ask you, Debbie, though, really quickly before we go on, you mentioned kind of cash versus accrual accounting. There's also a disparity between the federal credit reform programs that are on the budget versus the fair value accounting standard that honestly, Debbie Lucas probably deserves a statue or some kind of commemorative plaque at CBO, because you introduced this, and during the financial crisis, no less. But can you talk just really quickly about that and the disparity it creates in the 1 minute we have before I hand it over to Paul?
Okay, so what I was doing here is I was saying the problem with government accounting is it doesn't recognize the cost of market risk. That's where finance comes into this part of public policy. US budgetary accounting does treat credit and those kinds of obligations better than most countries because it actually does look at discounted present values, but it doesn't do any risk adjustment. And so, for instance, the US government for a long time treated the student loan portfolio as generating substantial profits, even though on any kind of an economic basis it was making losses. And it is something, it's another thing where the signals, it gives to policymakers, lets them say they believe things to be true which aren't true, so because of that. So some people felt like student loans were breaking the backs of students, which in fact they may be, but it's not because they're being charged an above market interest rate, it's because they're taking out too much debt. So
That's a great point.
Okay.
Thank you very much. And over to you, Paul. I know you're going to talk about Fannie Mae and Freddie Mac and pricing the government guarantee.
Oh, why is this here?
Oh.
Oh, I know why. Because I had an appendix.
This is what happens when you let us turn our own slides.
I know.
This is
No, this is my fault.
kidding.
Is there no more?
Take this down and take the other down. He should have a presentation. Oh, can you talk without your presentation?
I guess I could, but
Here, while they're looking for that, maybe we can give a minute. Let's turn it over
We'll hand it over to Mike. Could you put up the
You don't have slides.
presentation?
I don't have slides, but I'll
no
just
slides.
I'll just
Okay.
use Debbie's slides
No,
because
just-
no, because there's some points I want to make on top of these. So Mike Faulkender, for those of you that haven't had a chance to look at my background, I was the Assistant Secretary for Economic Policy, which meant I oversaw the Social Security and Medicare trustees process for a couple of years. And then most recently was the Deputy Secretary of the Treasury, and so I was part of the group that wrote the Sovereign Wealth Report that was submitted to the White House, and have also been part of both thinking about what to do about Fannie Mae and Freddie Mac, as well as what we do about the student loan portfolio. But before I get into further discussion of some of those examples, I want to talk about another piece of the problem we have with the way that we measure federal liabilities and federal assets, which is, and I contrast this as somebody whose day job is to teach executive MBAs how to do valuation. And so as anybody that's taken an elementary finance class knows, and as these presentations have kind of remarked on, you have a series of cash flows that you then discount back to present at a risk-adjusted cost of capital. And one of the things that I do recognize is that usually the people pitching a project, usually the project managers or the division managers, they really want their project to get funded. And so they use an over-optimistic set of cash flows. And so what your CFO generally does is use a cost of capital that's too high, because usually what we do is we go through in the class, you teach how to do the cash flow forecast, and then we get to cost of capital, and you teach the academic way to ascertain the cost of capital, and everybody says, my CFO tells me a number a lot higher than that. And the reason for that is, because you throw rosy cash flows at your CFO, and so they therefore use too high of a cost of capital in order to undo your bias. And you kind of hope that it works out, that the cash flows being too high and that the discount ring being too high, that the two biases kind of offset each other because you're dividing one by the other. The problem we have in the federal government is that we use optimistic cash flows and then we use discount rates that are way too low, right? And this is codified, or this is put into regulation through something called the A4 circular that the Office of Management and Budget puts out. And they updated it recently. And again, building on what Debbie said, they use a real discount rate of 2%. And so that real discount rate applies whether it's a risk-free cash flow that goes out 10 years or a risk-free cash flow, or a risky cash flow. And the previous paper that we just saw said if you're gonna think about these streams of cash flows, you really should be doing some kind of risk adjustment, and that's going to get you on the order of 3, 4, 5%. If you've got a term premium in there that's a couple percent, and then you throw an actual risk premium on top of that, you should be looking at more like a 4 to 5 to 6% real discount rate, and instead we're using 2. And as Debbie said, that then leads to some bizarre outcomes, and it's not just in Social Security, because I've talked to Senator Cassidy, Senator Kane about their proposal. What they say is, if we assume an 8% real rate of return on an investment in the S&P 500, which matches your real rate of return historically, and you discount an 8% rate of return against a 2% discount rate, right? Take that 6% differential, compounded over 75 years, I just solved Social Security. But of course what Debbie's saying is, no, we don't get to take $1 trillion, have it go up to 1.08 trillion a year from now, divide it by 1.02 and say, no, it's not worth $1 trillion we just put into it, it's worth 1.04 trillion, which is essentially the math of what they're doing. Then imagine doing that for 75 years. That's budget accounting. But again, it's not just Social Security. If you look at the pensions, so we have the Pension Benefit Guaranty Corporation. We had a few years ago the union pension accounts were, the trust fund for the union pension accounts was underwater. And so what's the solution? Congress gives them some money, not per se exactly to bail out the pensions. Instead, what it does is it lends them the money. So we do the accounting fiction of a loan, not a grant. And then it just assumes that what the pension plan is going to do is invest in equities and then pay back at a lower borrowing rate. So once again, we're just capitalizing the risk premium into solving the pension problem. Okay? So number one, we have a discount rate problem because we just use this 2% rate uniformly. And second is, it's not a constant 2%. We actually, the most recent A4 circular has actually a downward sloping term premium. Okay, again, any of you who teach fixed income know that the term premium historically is always upward sloping because the longer duration you go out, the more uncertainty there is, the more price impact there is. I can't think of an economic model that produces a downward sloping term premium. But if your objective is to say that really, really, really long-term investments, I don't know, like climate change investments, are actually going to be net beneficial and satisfy the supposed rigor of a cost-benefit analysis, well, one way to do that is to make sure that the really, really, really out-year cash flows are subjected to an even lower discount rate. And then the final thing is, again, the cash flows itself. And this is where I come back to my experience with Social Security. Again, a CFO has the objective of, they're actually accountable out to their shareholders for having generated economic value add like Debbie was talking about. But if you look at the people who oversee the cost-benefit analysis, usually they're responsive back to some kind of politician that has a political objective in mind, or in some cases is a bureaucracy whose objective actually is to maintain what they perceive to be a level of credibility. And so, for instance, the Social Security actuaries don't want to show that there's massive year-over-year fluctuations in the exhaustion date of Social Security. And so what they do is they take a very long time period over which to actually implement changes in forecasts rather than doing them immediately, and thereby having a significant impact. So when the original picture was put up of the Social Security Trust Fund, that assumed, so getting deep into Social Security for just a minute, there's two variables really that matter for the value of the Social Security Trust Fund over the next 75 years. It's the fertility rate and the mortality rate. It's largely a pay-as-you-go system. It's going to run a deficit every year out there. Discount rates are second order, GDP growth, second order, wage growth, second order. It's mortality and fertility. They, despite the fact that women are only having 1.6, 1.62 children, they're still at 1.9 out to forever. And that's because I'm the one that actually got the Social Security actuary to break 2. And that was back in 2019. But so despite the numbers actually going down to 1.6, if you look at the Social Security actuaries report, it's still at 1.9, which means that we are way underestimating the true deficit because, again, it's fertility that provides the present value of the tax revenue over the infinite horizon of Social Security that actually determines the present value of the revenue piece for purposes of the outstanding amount. So it's pervasive throughout the way that we do government accounting, and unlike the private sector, there's no kind of pushback to get you towards some kind of fair valuation absent the deserved statue of Debbie at the CBO.
That's great. And Mike, I want to turn it over to you, Paul, in a second, but I would love to ask you the question. And a lot of us are hoping for a 1983 style reform, like Alan Greenspan's commission. But you hear a lot of things that just kind of, a lot of people are assuming that to fix Social Security, it's not going to be real reform. It's going to be a general fund transfer. If what you're talking about is true, and in fact we're underestimating that, is it even possible to wholly depend on a general fund transfer to fix Social Security?
Well, as you put up there, the projections that you had up there already demonstrate that we're on an unsustainable fiscal path. In fact, I have told this story a couple of times before. My first week at Treasury in 2019, we were doing the very financial report of the US government that Debbie put up pieces of. And if you look at every report prior to that, the executive summary read, Section 1, where are we at? Section 2, where are we going? If you look at every report since then, it now reads Section 1, where are we at? Section 2, an unsustainable fiscal path. Because we briefed Secretary Mnuchin on it, and he said, we can't call this where we're going because the country will go bankrupt if that's where we're going, and we therefore can't go there.
Right.
And so, while I cynically agree with you that so even though current law says that once the Social Security Trust Fund is defaulted, there's an automatic across-the-board reduction in benefits because you cannot expend more in Social Security than the current receipts plus the value of the trust fund. So once the trust fund is exhausted, you can only spend current receipts, and that's forecast to be about 77% of
Yes, that's right.
of projected
Yep.
spending. So hence a 23% across the board cut in benefits.
Right.
There are some of us that hope that triggers an 83 type commission, but the cynic just says Congress is going to do the easy thing. Now, the question is that what are bond markets going to do? So are bond markets holding out hope that the exhaustion of the trust fund is going to be the trigger? Because again, if you talk to Kent Smetters at the Penn Wharton budget office, they will tell you that if you have current fiscal projections go out to infinity, their model breaks in about 20 years. And so they assume that there's a forcing mechanism that gets the long-term budget horizon back into balance. Some people, I think, in markets hope that it's the it's the forthcoming exhaustion of the trust fund that will cause it. One does worry if that just gets a general fund transfer. Right. Is that the event that some of us are worried about when markets just snap of a fingers lose faith and we have a bond market failure?
That's a very good point. I appreciate that. Thank you. And I want to turn it back. We now have slides up for Paul, and he's going to talk about another valuation issue with the government-sponsored enterprises Fannie Mae and Freddie Mac.
Okay, so now
You're on.
I'm on, and we're going from very broad discussions to one very, very narrow discussion. So I will confine myself to my areas of expertise, such as they are. Okay, so let me just start by saying that I'm speaking today as a researcher and as a concerned citizen, and not as a representative of the Boston Fed. And so when I say we, I don't mean Susan Collins, president of the Boston Fed, or Jay and me. Okay, so we're going to talk today just about Fannie Mae and Freddie Mac. So Fannie and Freddie, people think about them as doing a lot of things, but really what their main business and the activity that put them out of business 17 years ago was their business of insuring mortgages. And so Fannie Mae and Freddie Mac guarantee the timely payment of interest principal to MBS investors. And the goal of this was to insulate investors from borrower credit risk. And so the issue here, as we literally know, is that at some point, so they're on the hook to guarantee if a borrower doesn't pay, but what happens if they run out of money? And the assumption has been, as we all know, either implicitly that the government was going to step in. The investors in Fannie and Freddie MBS are widows and orphans and pension funds, and so no one is prepared to let them go. And so the reality is that the taxpayers bear the ultimate risk here. And so the question I'm focusing on today is really how big this liability is to taxpayers. And it's going to depend on many things, but I'm going to focus on three in particular. One is the level of the G fee, which is the money that you, as a borrower, pay to Fannie Mae for you pay it to your lender, and then they pay to Fannie and Freddie for the insurance. So the higher that revenue is, the lower the liability. The second is the level of capital. The more capital Fannie and Freddie have, the lower the taxpayer risk. And then finally, there's the riskiness of the portfolio. the more risky the portfolio is, the higher the expected losses, and therefore the higher the liability. So I'm just going to go into a little detail. And I asked if it was okay. There's a famous thing that with each equation you lose half your readers, I think, in a book. And here I'm going to lose half the audience. But I thought I'm just using addition and subtraction here. So I thought maybe that was going to be okay. And so the value of this, I'm thinking here in a very, very, I'm not going to worry about, there's no frictions here, there's no franchise value, and I'm going to think of the world as risk neutral. And in some sense, it's bad enough if you do that. So let me just say the value of the GSEs is whatever capital they have, the present value of all the G fees they expect to receive, the present value of all the losses they expect from credit risk on mortgages. And then this F here is I actually have this over here, is the put option value, which is basically they have the right to turn Fannie Mae and Freddie Mac over to the government when they're insolvent. And then the last part of this is a premium, which is potentially, it doesn't exist now, but it could, is a payment to the government in exchange for that put option. So the put option here is the key. This government guarantee, implicit government guarantee, is basically a put option on GSE assets, and this put value increases when capital is lower, and it goes down, goes up when risk is higher. So I'm just going to go through now just to illustrate this with a simple numerical example, which I hope will then illustrate where the more sophisticated calculations are coming from. So in the baseline, if we had the free government guarantee that Fannie and Freddie had, then we'll imagine there are two outcomes. There's a good outcome and a bad outcome. They start off with $10 of capital. The G fees are 20 here, and that's because in the bad state they lose 40, and in the good state they don't lose anything. So there are no defaults in the good state, and they lose $40 net of recoveries in the bad state. So the G fee is actuarially fair here. It's set at 20, and that means that if they were run as a normal business, then in the good state they would make $30, and in the bad state they would lose 10. But the point is here is we know that's not going to happen. The government is going to step in and cover that $10 loss, and the payoff to Fannie and Freddie is $30 in the good state and 0 in the bad state. And so you can see here, since they're equally probable, that the company they put up capital of 10, but the company is worth 15. And where does that extra 5 come from? That's the present value, the expected value of the government assistance. So the shareholders are receiving $5 in addition to the capital that they're getting. Now, if there were an IPO, in theory, a perfectly run IPO, the investors would pay for that put. But this is the status quo in some sense that we had in 2007. So the question of how we address this subsidy, there are many ways in which we could do it. One of them is, the simplest one, is just to recognize it as a liability. We can say that the government has this contingent liability. In bad states of the world, they'll have to pay out 10 here, and so we could just add that 5 to this government balance sheet. Another thing we could do is, if we think about this in flow terms, in other words, every year we're paying a subsidy to Fannie and Freddie for this, to pay for this option, then in flow terms, we could just add it to the budget. We could just say in this 2-period example that we are spending, in addition to everything else, we're spending 5 just to cover this. And then the third thing, which is what I think thought we were doing all along, was design policies to eliminate this put option. And so let me just go through. So one of them was that we were going to have adequate capital. And so whatever the Act in the 90s, whatever it was called, that created OFEO. That was they had a stress test, and the stress test was supposed to cover this worst case loss. And so what did they do? They said, okay, instead of having $10 in capital, you'll have 20. That means that in the good state, you get 40, and in the bad state, you get 0. But that means you don't need any government aid. And that means that you put up more capital, but the government never has to step in. And so the put option value is 0, and the expected government cost is 0. So there's no government risk here, and the shareholders earn normal returns. A second one is a risk-based fee. So we go through all this, and we just charge the Fannie and Freddie $5 here. The GSE pays this government fee, and so now the net cost of the government is 0, and the shareholder NPV is 0. In other words, they put up $10 in capital for an asset worth $10. So the last one is risk regulation. And here, the idea is that we're going to limit the types of products and the types of loans Fannie and Freddie can make. To some extent, we already do, but we'll limit it more. And then, in the bad state of the world, the loss is small. That means the G fee is much lower, but it means that in the good state of the world, Fannie and Freddie make less money, and in the bad state of the world, they lose less. And again here, the government doesn't need to step in because they're making money in both states, and so we get rid of the subsidy. Okay, so how big is this number? This is obviously not; these are not realistic numbers. Just a full disclosure. And so one way to do this is work that Debbie and her colleagues came up with a methodology. Bob McDonald came up with a methodology to measure the size of this put option. And so here are some estimates. And so what you can see is, in a sense, that target asset liability is measuring the capital, and then asset volatility is measuring how risky the portfolio is. And so how big are these numbers? These are basis points. It's always funny about Fannie and Freddie. I talked to someone who worked at Fannie at some point who said that it was very hard to wrap your mind around the fact that the last 0 on their on a balance sheet is $1 billion. So if you see 5,000, that means 5 trillion, not 5 billion. And so you're just multiplying these numbers by a huge, huge number. And at some level, the other way you can think about this is these are in flow terms. So I remember I mentioned that you could either do this as a stock or you can do it here as a flow. And this as a flow, you're just thinking at some level, this is how much more a borrower would have to pay in a competitive market, because ultimately it's the borrower who's benefiting from the insurance. And the second thing to say, and this is the last thing I'll say, and then we'll turn it over, is that this also assumes that, obviously, as we know, all of my assumptions here were based on the idea that Fannie and Freddie have no control over what types of loans they make. But obviously, we know about options. We know that volatility makes the option more valuable, and so obviously there's a strong incentive in here for them to increase the volatility of their portfolio, and that will happen typically when they're in distress. And so these calculations down here show that if they do that when they're in distress, these numbers get bigger. And that is all.
Thank you. And we have about 2 minutes, but I do want to ask you a follow-up question. Actually, 2, but really quickly, just to point out, you mentioned kind of the perverse incentives, right? If you think about a public offering of common shares for Fannie and Freddie, you really want to try to get the valuation as high as you can. You really want to kind of juice the two entities. which includes things like I've even heard about, restarting the retained portfolios and allowing those to grow. You're making a bet on their growth and also the growth of the housing market. Can you just talk a little bit more about those perverse incentives and kind of what it means for those of us who look at the GSEs and think that really they're in need of some serious structural reforms, including, a look at perhaps ending conservatorship, or at least kind of winding down some of the government guarantee? What are some of those incentives at play?
Well, as you say, obviously there is this, as I already said, there is this incentive they have, obviously, to make the more valuable, that's the perverse incentive here, right? Is the more valuable the option is, the more valuable they appear to be when you're selling them. So if you're trying to get the biggest price,
right,
then you'll basically give them this very valuable option, which you're not accounting for anywhere else.
Right.
On the books. So yeah, that's the risk you run.
Right. No, that's right. And then really quickly, winners and losers of a public offering. Talk about borrowers. How do you think borrowers would fare? Any other entity linked, shareholders, bondholders, liquidity, capitalization of the entities? How do those fare?
Well, I guess I would say, you're looking at these numbers here. The problem in our current environment, and I'm not going to say anything, not saying anything exactly political here, but all we hear about when we go out into the world here from the Fed is complaints about mortgage rates and high interest rates and about mortgage rates. Yeah. And so going in and saying, oh, we need to do this right and we need to make sure that everybody's paying the real price here is something that someone coming in and saying, oh, no, they're doing such a great job here with the risk regulation that in fact it's not going to cost it'll never cost taxpayers anything. Right. I think they're going to get much more of a hearing than someone coming in and saying, no, this risk regulation isn't going to work, and fixed rate mortgages may seem safe, but Fannie Mae and fixed rate mortgages put Fannie Mae and Freddie Mac out of business 17 years ago, and they could do it again.
Right. Thank you very much. Do you want to add something to that, Mike?
I would just say, the concern you have, FHFA was created as the new regulator replacing OFAO, and the concern you have is that the same pattern is going to be followed, which is because they only regulate the GSEs, they're eventually the regulator's going to get captured by the GSEs, and then you're going to relax the risk oversight of them. And so, a discussion that has happened is, should you move FHFA into something like the OCC so that they are not solely creatures of the two GSEs and therefore are less likely to get captured, and instead are regulated like other financial institutions where we care about risk-taking and capital requirements and
right,
make it more difficult to capture them, because otherwise, we know what happened running up into 2007, 2008. If you walked in with Bob and Debbie's paper into OFAO, they would say, these are crazy. Like, we're not going to have a nationwide meltdown in housing prices that's going to put the guarantee on the hook the way that you're estimating it, and that's just going to happen again if you have the ability of a captured regulator.
No, that's a very good point. Debbie, I don't know if you want to add anything. You could add anything on any of these topics.
No. On Fannie and Freddie, do I have anything I really want to say? No. I will say, to get back to kind of the asset sales aspect of it, there's a lot of valuations floating around, and I just think it's very important that the government structure the sale in a way that's sufficiently competitive that it reaps what it can, given our fiscal situation. I'm just going to mention a subtlety that didn't come up that people might not be aware of, which is what happened when the government brought them into conservatorship and basically bailed them out, was that the government guaranteed that they would keep their capital at least zero, right? So after the bailout, I think close to $200 billion went into Fannie and Freddie to make up for their losses. But in return, the government received these senior preferred stock claim, and then they also received some warrants. And this is kind of standard with bailouts. If you go back to the financial crisis and TARP, the big banks also gave the US government stock and warrants. And so the issue for Fannie and Freddie right now is that, at least in terms of their book value, the government's claim is worth way more than the value, that is, the government's equity claim more than eats up the equity on their balance sheet. And so a lot of the tension in the world is, with the IPO, is the question of, well, private shareholders aren't going to buy shares in Fannie and Freddie if all that money is just going to go to pay the senior preferred shareholders, the government. So somehow the government claim has to stop being senior before the private sector will come in and pay any money. And so I suppose, this is just speaking for myself, my concern is that in an effort to make a sale palatable to the private sector, the government will write down their claim more than they have to. But that's a very tricky measurement issue because their book value isn't their market value. So if you do back of the envelope calculations on their market value, you're closer to a situation where you can at least cover some of the government's plan. It's even more complicated than that, but I'll leave it at that. I'm just going to say that the tension, though, is there are private shareholders still, and if you look at the time series of the stock price of Fannie and Freddie, it basically went to zero, but it's showing signs of life. And you can call that sign of life kind of a call option, if you will, on if the government decides to write down its stakes sufficiently, then those private shares could potentially have value. So there's a lot of big institutions involved, a lot of moving pieces, a lot of commentary on what markets will and won't buy.
You've got the preferred shares as well.
And you have, I didn't even want to mention that. Yeah. So there's also private preferred shares. It's quite complicated, and just, hoping that there'll be some discipline and transparency would be a good thing.
It would be a big wealth transfer, though, big subsidy.
It could be a big wealth transfer to Wall Street, but hopefully it will not be.
Yeah. Good point.
Personally,
we have 10 minutes left, and I'm supposed to be the timekeeper, so I want to open it up to questions from the audience. And I don't, do they have to go up to the mic?
To the microphone.
Yes. And I saw your hand first, and then yours.
I'll just talk loud. I'm Robert King from Boston University, and I've got the world's leading experts on a topic that I don't understand very well. A couple of years ago in the money and banking course, I looked at some essentially derivative instruments that Fannie and Freddie were using to offload a portion of the credit risk they had taken on. Now, that seems to me like the kind of thing that could be legislated. They could be basically limit their position, and that, I think, would have the effect of mitigating some of the concerns that you guys have described. So are there any prospects for regulations along those lines? I thought those were brought in the minutiae of the Treasury Department.
Yes, there are credit risk transfers on their books as part of their risk management process. In the formula that was provided before, that's going to alter your sigma because you're not bearing all of it. You're transferring some of it. I don't think they're all that much different than credit default swaps, just on mortgage portfolios.
Do you want me to see? Okay, I think about these a lot. So those securities actually were part of the legislation that brought them into conservatorship. So they were required to start transferring some of their risk to the private sector, and they did create these securities that are highly structured credit risk securities. It's kind of questionable exactly how much risk they are transferring because they retain some of the risk and they sell some of the risk, and it's actually up to them how much risk they sell. So for instance, during COVID, they stopped issuing those securities for a while. So if you want a mechanism like that, if you want to use a mechanism like that as an alternative or a supplement to capital requirements, you have to be a bit careful because it's hard to control the risk if you give them the choice. That is, when those securities became very expensive to issue, they started to issue a lot less of them. So I think it is a good idea. I mean, in general, it's a lot like the COCO bonds in banks.
Yep.
It's kind of the same principle of, can you change their capital structure in a way that makes them less risky, or you just want to put as kind of a simple capital requirement, which is easier to monitor.
Basically making them sell the first loss portion seems like something that would go.
They actually keep the first loss portion, but the risk is not in the first loss portion. The risk is in the piece right above that, but don't quibble about that. Okay. Yeah.
Interesting question. And then go to you next.
Point of information, the 1.5 trillion is the student loans. What is the size of mortgage loans? 1.5 trillion was student loans. How does that compare to the mortgage loans?
Yeah, they're 5.5 trillion or something, 6 trillion.
Okay, 3 times worth, okay.
Yeah, 6 trillion on Fannie and Freddie, I think.
Thank you. Because
1.3
it strikes me that student
Yeah,
loans.
no, yeah, and yeah.
It strikes me, this could be wrong. Student loans, if you're borrowing $10,000 a year, it goes to the student. If you're borrowing $50,000 or $60,000, like these institutions, and then a couple years of grad school, you've borrowed $200,000, parents plus loan. So the working life of the person paying it off is one more year before retirement. And so there's this huge put option. And you explain it to the banks, and they say, we don't care. So does the government appreciate, if I'm right, that a large percentage of the student loans might have this glorious embedded put because it's on the parents? My data might be wrong. That's anecdotal.
Well, so that's why in the most recent legislation, they changed student loans, and I thought we got rid of parent pluses and capped grad pluses. Because again, I can make the argument of a market failure for an undergrad loan. I can't make the argument for a market failure on a parent loan. So yes, there's a recognition of the perverse incentives and what it was doing to the lending portfolio.
Okay. Other questions?
Okay. Okay.
Anyone else?
Can I just say one more thing about
Yes,
student loan
do you want
portfolio?
closing remarks?
No, before we get to closing.
Yes.
In the first term, I know we looked at selling the student loan portfolio, and I was against it because I thought the government is always going to be in a better position to collect on student loans because we have the federal government has the ability to garnish paychecks in ways that a private bank does not. So I was against because I didn't think we'd be able to sell them for fair value. Once I saw that they could potentially be forgiven for political purposes, whereas if you sold them off, they could not be forgiven, I flipped my view on it entirely. So again, I used to think that the government was the best collector because it had the best collection mechanisms, but now I'm convinced that maybe they're the worst collector because they're the only lender that would forgive them.
Good point. Okay. Well, thank you. Do you have any closing remarks, Paul, Debbie? We've talked about a lot of different topics because you can see that valuing assets and liabilities is really important, and understanding credit programs and kind of the value on the balance sheet and beyond. Thank you. And with that, I don't want to keep folks. I think we have dinner and drinks next. Is that right?
Drinks first.
Good, drinks. I need a drink after hearing all that, but
Okay, thanks.
thank you.